Happy Friday. Happy start to the school year. Happy start of the football season. Trying to stay positive here before we get to this show today. My name is Dano Weir. I'm the marketing director for Sonoma Wealth Advisors and our Fermata family of brands, Fermata 401k, Fermata Tax. Fermata is our SEC entity, and you are one of our clients, or you're thinking about becoming a client, and you're going to get up to date with some straightforward financial market updates. That's what our show is. Be joined today by Chris Sipes and maybe Daren Blonski. We're going to see if he comes in the side door or not. He had a conflict, but I think we're going to make it happen. So what are we talking about this week? Might be rate cuts, but we're actually asking why you might want to be careful what you wish for when it comes to rate cuts, why that might be a scenario where we're facing a major economic downturn. Also, why single family homes are looking like 2008 right now. And in the last 20 years, should you have been in all gold or all stocks? Joke's on you. It would have been a push. More on that after this.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax, and Fermata Insurance. On the Markets starts now.
Now, Chris, I was promised that rate cuts were going to fix everything. In fact, the president seems to think they should be at 0%. But the thesis for today's episode is maybe not a good thing.
Well, I guess it depends on the reason why rates are going lower. And while the Fed has some control over parts of the rate market, they don't have full control over all the rates. And the last time that they cut rates, which was about a year ago now, they cut 50 basis points. And right before the election, famously, which was somewhat controversial, and the market rates went up. So even though the Fed had cut rates, which usually leads to the markets, kind of following that, the market actually priced a higher rate in. So the Fed, despite what many say, doesn't control everything. And the market is going to price in the outcome that the market feels is most likely. And when I say the market, I mean, millions of people around the planet, if not billions, putting money in, placing their bets on where things are going.
And just to, if you are in the know, this is going to sound super rudimentary, but it always bears repeating, in my opinion, which is that some of the basics here are you've got the Federal Reserve, and they set what they call the overnight rate, Chris, and that determines what they believe the percent that should be charged on money that is loaned. But then that, as you just said, is not actually the real rate, because the market then determines, here's what we're really going to charge. But setting that rate and the changing of that rate flows downstream for so many things, correct?
That's right. It's the overnight rate for banks in the Federal Reserve network. So it's an extremely short-term rate, but that short-term rate is kind of what the rest of the market ends up getting priced on. Because if you think about it, that's like the beginning of money lending, and that is what banks charge each other overnight to lend to one another to settle up. And banks have to be constantly moving money around to make sure that their books are closed for the day, right? So with all the deposits and money coming in and going out, and so that rate is kind of the base rate on the super short term, literally overnight, and then rates flow out all the way to 30-year treasuries in the U.S. So there's all the time frames in between. And we commonly call that the curve, the rate curve, which usually looks somewhat like a Nike swoosh or in that direction, where typically it costs less to borrow money in the short term than it does to borrow money for a longer period of time.
All right, so just clarifying that there is not a government organization in the sky that's setting your mortgage rate per se, but they certainly have an influence on it, and we're going to look at why several factors have come to a confluence, and the general belief is that there is a rate cut coming, but that may be a bad thing. So we'll look at that. We are Sonoma Wealth Advisors, part of the Fermata family of brands, Fermata 401k, Fermata Tax. We are your hosts today. We're going to get Daren here in a little bit. But Chris, the managing principal, myself, the marketing director, and a trained podcast host, so I have the voice. Chris, I was loving seeing you rock an Attack of the Clones, a Star Wars meme this week. And tell me what we're looking at here.
Well, this meme's been used many times. It's one of my favorites, right? And for those that are just listening, the guy says we're getting rate cuts, and
the guy is Anakin Skywalker. The girl is Padme,
yes,
right? Queen Amidala from Attack of the Clones, and this is from Star Wars.
Yes, she's looking back at him and says, "Because inflation's falling, right?" And he just looks at her, and then she says, "Because inflation's falling, right?" And for those that watch the show know and really follow the markets, the Fed has two mandates, which is price stability, aka keeping inflation under control and deflation under control. And the other mandate of the Fed is full employment. So it's sort of like we've talked about over the last few weeks is which one are they going to pick if they have to pick one, right? Because inflation has not come back down to their target. And just a week or two ago at Jackson Hole, Powell said, hey, that whole 2% average that we were shooting for, forget about that. We're no longer shooting for that because they basically couldn't get it under 3. And so they've already kind of removed that as a goal. And then today we got the job numbers, which were not good. And the market, the rates market really sold off, meaning the rates went lower in anticipation of, hey, that's not good. The economy's slowing. There's going to be less demand for money. The Fed's going to lower rates. And so, yes, the rates went down, but not because inflation was coming down. The rates went down because the labor market outlook is not great.
So we're looking at kind of a nightmare scenario where prices are still high and people are losing their jobs.
I'd say it's too early to tell that at the moment, but yes, that would be the worry. You don't want high inflation with stagnant or retracting growth. The old stagflation. That's not a good situation to be in. Now, we talk a lot about how the U.S. market's concentrated, it's expensive, but it has been for years. What can you do about it? Well, one of the areas that have really been shining so far this year is global equities, and we'll look at that throughout the show. And this from Visual Cap shows the cycles that we've been in over time between U.S. equities and international markets. Now, first one, I didn't even realize that in 1985. The global markets outperformed the U.S. by that much. That's wild. But we used to have kind of bigger swings, more frequent swings. Really, since the great financial crisis, we've been on pretty much U.S. all the time, almost every year. And every time that the international markets have started to outperform, that quickly reversed. And so this might be another one of those. This chart was made in February, so the U.S. market is lagging behind the international market by even more now that we're in September. But that could be a place, if you don't already have some of that exposure in your portfolio, that you might want to consider looking at for some diversification benefits if we're starting to see some headwinds in the U.S. economy.
Chris, if there's a client right now who is not sure whether they have some or they want some, what do? Call their advisor and say, get me some of them global equities? What do you buy? You just go buy a German tire company, or what do you do?
I suppose you could. Typically, picking an individual stock is really tough, like we've talked about. I will say that usually we kind of use clients requesting something as a telltale for, hey, maybe this is, an overcrowded area where the market's, everybody's piling into it. Famously, AI, that we've gone through time frames where everybody's calling like, how do I get more AI? How do I get more AI? Well, look, even if you just own the S&P 500, most of your portfolio is in AI. So it's maybe not necessary to go ahead and compound that even more, right? But I will say that almost nobody has called and requested foreign stocks. Now, there have been a couple actually over the last month, which is interesting, because really, maybe it was about 2 years ago or so, I would say, we had definitely more people saying, why do I own foreign equities at all? Like, why do we have them in the portfolio? That's the thing about diversification, is that you never know when the catalyst happens and when the change happens. It's only obvious in hindsight. And so sometimes you got to go through those times where you're looking at items in your portfolio going, oh, why do I own that? Because sometimes it's just right around the corner where they start to perform well. And so this year, so far, what you're looking at here is the start to the year. The blue line is the U.S. equities. And they're having pretty close to their worst year since 2009 versus global equities. So, and I listened to an interview this week with the head of macro at Carlyle, and I'm blanking on his name, so I'll have to I apologize on that. But he was just mentioning about how in the early 2000s, when the international markets, specifically the emerging markets, were far outperforming the U.S., at that time it was, hey, if you want growth, you got to be in the emerging markets. They're the ones with the demographics. They're the ones with all the growth. They're the ones that are adding all the manufacturing and output and production and et cetera, et cetera, et cetera, versus the U.S., the demographics are poor, there's no growth opportunities, yada, yada, yada. Kind of similar to what you're hearing about international stocks today. And so be careful of the narratives, right? We're susceptible to narratives. We're susceptible to wanting to follow the crowd. And a lot of times at these turning points, it takes a while for that narrative to change, and you might miss out on that growth at the turn, because usually at the turn is when you see the most outperformance, the most relative outperformance is at the turn. And by the time it's accepted knowledge, usually that's too late to get a lot of those returns that you might have seen otherwise.
Was the interview with Jason Thomas, Chris?
Let me see here.
Head of Global Research and Investment Strategy of the Carlyle Group?
Yes, it was on the podcast with Alex Shahidi, and that's an excellent podcast, by the way, for anybody that's interested in listening to some investment, really good investment videos or interviews from some of the top minds in the investment world. So this is the sentiment indicator. And from AAII, we're roughly even across the board again this week, so not a whole lot of change here. Again, we look at this for extremes. When you see extreme bullishness or bearishness, it can be a sign that people are piled on one side of the boat or the other. This week, we don't really have that, luckily. Now, the CNN Fear and Greed Index sometimes agrees with this from AAII, and sometimes it doesn't, because it's more of a positioning related index where it's actually looking at 7 different positions in the market. So it's more based on how people are actually invested, is a better way of saying it. This week it does match up with the AAII chart, and that it's neutral. 52 right in the middle. It's down a little bit from last week. It was at 60 greed last week. Bitcoin also agreeing at neutral, 48, and that is unchanged from last week as well. So really kind of meh in the markets this week. There's not a lot of sentiment, I would say, quite yet in the markets. Now, what caused the big brouhaha in the markets this morning? Well, that was the unemployment, or sorry, not unemployment, the employment number, which also led into the unemployment number. Now, for those of you who have been following, there's been a lot of drama. It's been almost like a soap opera with the Bureau of Labor Statistics. The numbers came out last month. President Trump fired the head of the Bureau of Labor Statistics because they revised the numbers down dramatically, and so they got rid of the head last month. And so this number was highly anticipated. They were expecting 75,000 new jobs in the month of August, and the actual number came out after a delay, I'll add, right before the number came out at 8:30 Eastern. The BLS said, hey, we're having technical difficulties. Of course, everybody gets all upset. What's this mean? Of course, there's technical difficulties. Are they trying to hide something? The number comes out and it's 22,000, a huge miss. And the market rallies, which is, would you guess that, Dan? With a horrible number?
No.
Would you think the market's going to...
And this is why timing makes no sense. Like the people who think, if only you knew, if I knew the job number, then I could have done this and I could have shorted that. And it's like, oh yeah, well, what about when it does something that's totally counterintuitive?
Yeah. So a huge miss. The market initially rallies dramatically on the assumption that, okay, this is a reason for the Fed to lower rates. See, the job market's weak. You have cover to lower rates, not only by 25 basis points, which is pretty much baked into the cake at this point, but hey, maybe they'll go 50. Now, this is from earlier today with the CME group, and this is the futures market on rates. And so you see that 14.2, that was the probabilities that the Fed cut by a full 0.5% at this next September meeting. Now I'm looking at it right now, and that number has dropped back down to 8% probability. But today's the first day that we've seen any probability of a 0.5 point cut. And there's currently no probability of them keeping rates the same. So the market has obviously taken this job number into account and said, hey, now we've got a higher probability that rates are going lower. And therefore the market initially rallied and then sold off. And we ended the day pretty much flat in the S&P. We were down, looks like about 32 basis points. So not a huge move in the S&P, but a very decent size move in all rates, really across the curve, from short term to long term. Rates dropped pretty dramatically on this news.
Chris, I'm watching this Cowboys Eagles kickoff to the NFL season last night, and towards the end of the game, there's a big fumble, and it's now looking like the Eagles are just going to walk away with this. And wouldn't you know it, lightning delay right on cue. And it's just exactly the same as, oh, we're going to release the job numbers. Oh, technical difficulties. I mean, the whole thing is scripted, and you can start laughing at any point if you want, because I'm being facetious. But isn't it always funny how right at the last second, perfectly timed, here comes the technical delay, the weather delay, the lightning delay.
Well, and anybody that's ever bet on sports, I think, can relate a little bit more to how markets work. Because sometimes you're like, oh, okay, this is so obvious. The hive mind is off. There's no chance that these odds are correct, right? And I know better. I'm gonna take this bet. And lo and behold, half the time it's like right at the end of the game, something changes and boom, it falls right within the spread. The team wins that's supposed to win, and you're like, you lost your money.
Got you again.
The hive mind is usually right.
That's right. Speaking of 4D chess, He's Daren Blonski is in the studio. Daren, welcome to the show. He is a great player of 4D chess. He's always thinking in multiple dimensions.
You know what I loved about joining a little bit late? I'm a little bit late today because I was finishing up a call, and I come on screen, and very first thing I hear, Dan, is you talking about football. But, what made me happy about that is at least you weren't talking about Disney, Dan.
That's right. Or Nintendo. So I'm a simple man.
Disney or Nintendo, I'm good. Let's do football, buddy.
All right, Chris.
That's right. Okay, so we just talked about that non-farm payrolls number. That's the 22,000. I'm almost surprised that the market reacts so much anymore because we know these statistics are not right. Like we've already been, told how they come up with these numbers and why they get revised by so much. And like, yes, it's statistics and they're trying to be pretty close, but it's not like this number is sent down from heaven, as you said, Dan. It's a moving target and it's probably going to get revised. However, the market reacts and hangs on every word, especially with all the drama going on at the BLS. Everybody wants to know. But if you look at a longer term, it's really kind of just in line with the trend. So we're not adding a ton of new jobs in the U.S., but it's not like this number has just dropped off a cliff or shows any huge signal when you look at it over a little bit of a longer term metric. So that led to the unemployment rate, which ticked up from 4.2 to 4.3. And why we always put this chart on here that goes back to the 50s is so that you can see that cycle that tends to happen over time, and the gray areas being the recession areas. And what you tend to notice with this is that unemployment goes down, down, down as the economy is expanding. And obviously, when we hit a recession, unemployment goes up, and it tends to go up very quickly. At least in the past, when we've had prior recessions, that unemployment number moves up very quickly. And so we got very low. We got to 50-year lows in, I believe it was 2021, in terms of unemployment rates, sub 4%. Anything under 4% is extremely low. Really, anything under 5% is considered pretty low historically. And but now we're ticking up to 4.3. But again, it's not like you're seeing yet a huge jump. I wouldn't say that there's a massive jump in the unemployment rate yet to where you would say, yep, obviously we're in a recession. But that number is trending on the upward trajectory on the employment side of things. So let's take a look at the 2-year rate. And the gray line is the Fed funds rate. The blue line is the 2-year treasury. And I hesitate to bring this up since, Bob Elliott was like very kindly sort of like, I don't think that whole theory holds any water about the Fed funds following the 2-year treasury. Or maybe you guys heard it differently, but he didn't seem to put as much credence in it as we do. But we're almost a full percentage point off in terms of what the 2-year treasury or the market, aka the market, the 2-year treasury rate is set by everybody betting, right? And what the Fed funds rate is, which is what's set by the Fed, which is that gray line. That spread, that 1% spread, is about where we were last year at this time in September when the Fed also cut. And at that time, they cut by 50 basis points. And that's where you see that drop, that dramatic drop in that gray line. Now, why we kicked off the show with, hey, be careful what you wish for with lower rates. What you'll notice here on this chart when you look at the gray lines for the recessions is that when rates go lower, they go lower quickly, and it tends to be in response to a crisis. So the Fed comes in and tries to stimulate but also the market is also lowering rates based on the fact that there's less demand. There's less demand for money when the economy is not expanding. People don't need to borrow money to buy houses, to expand their businesses, to buy cars, to, do all the things that they need to do. There's just less demand in the market when we're going through a recession, which lower demand for anything is going to lower the price. So you get a lower demand on rates, and that price is going to drop. So if rates were to drop from where they're at now to down to say 1%, or 1.5%, which I've heard thrown around there a bit. First off, that would be a huge difference for the Fed funds to be that far ahead of the 2-year rate. But if the 2-year rate dropped down to 1 or 1.5%, and you didn't tell me anything else, I would assume something pretty catastrophic has just hit the economy and the markets, and that the market is screaming like, hey, this is bad. So hopefully that makes sense. I don't know, Dan, let me pause there and see what you think.
I mean, it makes sense to me, Chris. But Daren, what do you think?
I just trust whatever Chris tells me. That's what
You guys are watching football on the other screens, aren't you?
No.
I was actually looking at the non-farm employment change and the way they just adjusted the June number. So we actually lost jobs in June. And thinking to myself how utterly ridiculous it is that the market even cues off the job numbers when they're this drastically wrong every quarter.
Exactly. Exactly.
It's just stupid.
We're hanging on these numbers every time. And, that brings up a good point, too. I feel like really this whole COVID era, we've been so trained to follow every single thing that the Fed does that we're following these numbers like so closely. The inflation rates, the payroll rates, because everybody wants to know what the Fed's going to do, because everybody feels like Fed equals what the market's going to do. Right? It's kind of like the Fed is training the market to feel that way. And, this reflects the fact that people feel pretty confident that the Fed and the government are backstopping the equity markets, right? Because if you look at the aggregate financial asset allocation across households, mutual funds, pension funds, and foreign investors, people are into equities, and they're into equities probably more so than ever, at least going back to the 50s in this chart. And this is even higher than we saw during the dot-com boom. Now, obviously, the companies that are dominating today are completely different than the companies that dominated during the dot-com boom when there weren't profits. A lot of these companies were pre-revenue, et cetera. And now you've got maybe the best companies ever created by man dominating the market, but still you have a concentration of equity value in these large companies, in these large US companies. And I think maybe for the first time ever, you have all those companies pretty much doing the same thing. It wasn't like the 50s. And Dan, you'll have to mention that person from Carlisle again, because I have to reference him that
Jason Thomas.
Yeah, he brought this up that the diversification is really lacking now, given the fact that those concentrated companies are basically in the same industry, providing much of the same services and et cetera. So it's not like the Nifty 50, that were all blue chip companies, but in different sectors. They did different things, produced different things. So you got more diversification back then during that particular run up in those companies than you have now, where you're really just concentrated in the tech sector, and so it's a different thing today. Now, on the flip side of that, debt, which is bonds, underowned relative to history at only 17%, and then cash at 13% is kind of about the same as usual. So it looks like people have really taken money from their bond allocation and put it pretty much exclusively in equities.
I want to try to give an example here of what I think you're talking about, Chris. If you're listening right now, let's say you were a person who wanted really big muscles and you really like the look of having being really fit. And all your friends started taking steroids, and what did they get? Really big muscles, and they stopped eating because all they needed to do was do the steroids to get the really big muscles. And Chris is over here saying, hey, if you eat a balanced meal, you need some vegetables, you need to work out, but you also need to sleep. Chris is preaching that, and they're saying, my friends are just getting muscles off the steroids. I just do the steroids. Is that not kind of the difference between all equities and a diversified portfolio?
Yeah, I think that analogy works. And you know what? It's not, you can't blame people for feeling this way, right? Because just taking steroids has worked.
Right.
They're getting the bigger muscles. They're not.
Of course. But it's got an inherent, eventual, blow up date, right? I mean, it's not perpetual. It doesn't seem sustainable.
Sure. I mean, and the thing is about all, market history is that each time it feels like, well, yeah, steroids didn't work in the past, but this time, let me tell you, it's a different kind of steroid. This is a special
from the Bay Area Lab Corporation. It's going to be great.
They told me there's going to be no side effects. I'm sure it's going to be fine, right?
This is not steroids. This is HGH. Totally different.
Yeah. So, and people, we all suffer from something called recency bias. And when you look at the time between the S&P 500 all-time highs, this chart shows that really since the great financial crisis, buying the dip has made sense. And a lot of times those dips have just been a few weeks. So there's really, market participants it's that Pavlovian response, like we said with the Fed. And it is the reason why everybody hangs on every word of the Fed, because everybody's been trained that the market comes back quickly. Every time it goes down, there's going to be something that brings it back up, and valuations don't matter anymore, and don't worry about concentration. These are the best companies ever, et cetera, et cetera, et cetera. And so it's easy to see why people are looking at that as the easy way out, and the low risk way. But just like, with the wildfires in California, we all know that if a place is burned previously and it's been a really long time since it's burned, that actually builds the risk. It's not like you look at it and go, well, it burned 100 years ago, but it's been 100 years since it burned, so we're probably good to go. You would look at that and go, geez, now the risk is elevated, because now you've got all the trees that are mature, and there's tons of brush and everything everywhere. So it's not like, well, it just got burned last year, and so there's really nothing left to burn, right? So hopefully, I don't know if that we're mixing metaphors here and analogies.
It works.
But if you look at the CAPE ratio, which is the cyclically adjusted price to earnings ratio, and this is looking at earnings over a 10-year period. So it's trying to look at a longer time period to say, hey, where are we going? And a lot of people will say, look, CAPE ratio has been elevated for a long time. So if you just invested solely on this, you would have not participated in the S&P. And that's not what we're saying, right? It's just more consider moderation, instead of just throwing everything into that one asset class or that one company. That's why you want to look at some moderation, because while in the short run, it's a terrible timing tool, in the long run, it tends to revert to fundamentals. And you can see at the previous times where the CAPE ratio has been elevated, when you look at the 10-year nominal return, which is not net of inflation, returns tend to be low going forward in the 10 years. And if you look at the real return, which does show you net of inflation, it's not a good place to be. Right. So take the 70s as an example. While the nominal return, so yes, you got positive returns in the S&P when that CAPE ratio was elevated. However, the real return, after you took into account inflation was negative. And so now the vice versa of that is, okay, well, if it works on the expensive side of things, does it also work on the inexpensive side of things? And the answer is, it looks like, yeah. When you go back to the other prior times when this CAPE ratio has been very depressed and very low, the forward-looking 10-year nominal returns and real returns have been very high. And so most people forget that even though when you look at a long-term 100-year average of the S&P, you say, oh, it averages, 10% a year. Okay, and that is usually made up of many years of 15 to 20% returns and many years of 0 to negative returns. And it hardly ever just, falls right into that nice clean slot in the high double digits. Now, speaking of an index that has not gone anywhere in a while, we look at the Russell 2000. This is the U.S. small cap stocks, which have lagged the larger companies. And this is from Seth Golden. He says the third longest streak without the Russell 2000 achieving a new all-time high. Will 2025 end this streak? History identifies one catalyst in particular that ended such streaks in the past, maybe just around the corner: Fed rate cuts. Each major streak ended via lower rates. So this streak that he's referring to is the streak of not getting an all-time high. It's not exactly a streak you want. And rate cuts previously have been disproportionately beneficial to small companies. I'd venture to guess probably because small companies borrow more money and need more, credit to function and grow, etc. So when that cost of money comes down, typically those smaller companies seem to be the beneficiaries of that. At least in some way. And speaking of beneficiaries of fiscal policy, gold hit another all-time high this week, and this from Charlie Biello, showing total returns of gold versus the stock market. So stock market in blue and gold in gold. Going back the last 20 years. I don't think most people would guess this, and I think it's surprising to most people. What's also interesting about this to me is the correlations of gold and equities over the last 5 years or so, because previously, if you look like 2015, I guess it would be further back than 5 years, but if you look prior to like 2015, you can see that gold kind of went the opposite direction of equities. Remember, right after the great financial crisis, everybody was piling into gold. That topped in like 2011 when the European debt crisis was happening, and everybody said, you just put your money in gold because everything's collapsing. The U.S. going down, Europe's been down, going down. And so they were moving in opposite directions. And now gold and equities seem to be moving together, which is abnormal. And I believe that 2024 was the first year ever that both gold and the S&P were up over, I think it was 25% in 2024. And so that's not happened before. So I'm not exactly sure what that's saying at this point, but it seems to be the market saying something when you look at that type of incident.
And Chris, I think when you look at that peak in like 2011, 12 there for gold, right, and then it starts to come back down, that slide is such a perfect moment for an investor who will feel like, oh, I missed my moment. Now it's going down, and this is just a downhill slide, right? If you're an individual investor, you start to think those things sometimes, I think. And look where it ended up going if you held it. And that's not indicative of everything, right? Past performance, not indicative of future results. But in this particular case, it's a perfect example of if you didn't need this right now and you held this particular gold ETF, you'd be higher right now.
Well, that's a great example, Dan, because 2011, you look over, when did it went down, and it never got back to its peak until 2021. So that's 10 years. right? And while you're looking at this chart, you're like, oh, no big deal. I could have done that. But remember, investing years are like dog years. Every year feels like 7 years.
Mm-hmm.
So, yeah, you're exactly right. That's a lot of years of looking at your portfolio going, gold's down again. Gold's down again.
I
Gold's
could have
down
sold
again.
it at. I could have sold it at. Right. But do you need
Yeah.
it right now? No. If you didn't need it right now, could have been. Anyways, good, interesting exercise, I think, to look at.
Absolutely. Yeah. So now you teased this at the beginning. I found this interesting that new single family homes for sale have reached 499,000. Talked about how the housing market's all whacked out right now. Record, what do you call it? Unaffordability. When you look at the price of the average home versus the average income. And however, when you look at the number of houses for sale and you think, okay, if more supply is coming online, if more houses are for sale, typically that leads to lower prices. Now, I don't know for sure, but when you look at the previous recessions that we've had and home prices, I guess maybe in the mid 90s would have been kind of the only example where we had a ramp up and a fall off in homes for sale that wasn't caused by a recession. But it's interesting that so many houses are for sale now. I would love. This is an absolute number, so I wish this was like adjusted for population growth, right? So like obviously 500,000 homes for sale in 2027, 20 years after 2007 is not the same because population's grown a lot since then. So it's not exactly adjusted for the proportions, right? So keep that in mind too. But nonetheless, we're elevated in terms of number of homes for sale when you look at the historical data here. Manufacturing PMI, we got that number this week, which was 48.7. This is like an activity indicator on manufacturing. Anything below 50 is considered contractionary. Above 50 is considered expansionary. And so we did get a tick up. However, we're not above that 50 yet in terms of expansionary in manufacturing. So manufacturing kind of continues its struggles that we saw starting in 2022 when that number went below 50, and we've really been in that manufacturing recession since then. All right, Daren, you going to take over on candles, or should we go through the asset classes with the simple moving averages, the poor man's charts?
The poor man's charts. I've got some candles. We can do both.
All right, let's do candles.
Definitely a few things I want to take a peek at on candles today.
Light it up.
All right, let's do that. Let's take a look. Chris, we haven't talked about Dr. Copper in quite a while. So I thought we would start with talking about Dr. Copper. Why do we like copper? What's so interesting about copper is the question, Dan, you might ask. Copper has historically been looked at as Dr. Copper, meaning that we tend to see market pullbacks come first in copper for whatever reason, just the nature of that particular metal, how it's used in industrial applications, etc. The pricing, it got pretty out of whack because the Green New Deal was pulling in and using so much copper for motors and transitioning off gas engines, etc. But very interesting that we saw this massive drop in copper going back to July 30th. And now we're just starting to see some cracks come through on the economic data, especially as it relates to the job numbers, which I talked about were absolutely hideous this week. What I thought most interesting, though, and I thought, so this is the non-farm employment change. And you can see we've been on a downward trend, which is not good. That means that we're not adding jobs. This month, the forecast was to add 75,000 jobs. We only added 22,000 jobs. But what's interesting about this data is the data comes out and then they revise the data. So you've got three different colors on here. You've got this light blue and then the dark blue and then the gold. And if you look at June's number, see how it came out, and the June number was at, let's see, I guess that's 136,000. And they just revised June down to right here, which is like 14,000 jobs were added in June, which goes back to what I was talking about earlier, how much of a joke it is. The market like cues off this number and then, oh yeah, no, just kidding, we got that wrong. The jobs data is very noisy. This is what we call a noisy data set. And so you can see the gold being the forecast, the darker blue being after the fact revisions. We're not seeing a lot of upward revisions. So that's important to note. Whereas like you can see back here in January, there was an upward revision. You can see in November of last year, upward revision. It's all either the revisions are coming back drastically lower or in line, and we're on a downward trend. That tells you that the labor market is softening, right? And so then the question is, well, how long does it soften before the Fed steps in and move rates? Getting back to some of what Chris was talking about earlier. When we look at the unemployment rate, actually, I'm going to look at the unemployment rate over here because I think it's a little easier to look at. When we look at the unemployment rate for the United States, you can see the tick up here, and we're ticking upwards, which is perfectly in line with the yield curve, right? We've talked about this a lot on this channel, but the steepening of the yield curve is often an indicator that things are going to slow down. We've started seeing that steepening. If the Fed drops the rate, so the way to think about this is the yield curve. And so what the yield curve is it's 1 month rate, 3 month rate, 6 month rate, 1 year, 2 year, 3 year, 5 year rate. So this is the government debt. So what you can get you can give the government your money and what you'll get paid to give it to them. So right now, currently, this is the current one.
I don't think we're seeing correct.
Oh, we're not seeing the right one. There we go. Yep. Sorry.
There we go. There's the Nike swoosh we were talking about earlier.
There it is. All right. So this is the current September 5th. Okay. This is the current yield curve. You can see the 1 month rate. So that means that if you gave your money to the government for 1 month, you would get 4.2%. If you gave your money to the government for 7 years, you would only get 3.791%. Now that doesn't seem very intuitive.
And those are annualized numbers. It's not like if you gave it to them for 1 month, they give you a full 4.2%. That's
correct.
That's an annualized, as if you got that same 1 month rate for a full 12 months.
$100 in January, you get $3 in December.
Sure. It's too late in the day for me to do that math, Dan. But what I'm saying is you don't get the full. You get 1/12 of that number. Right, because it's only 1 month. That number's annualized.
So like if you're a CD shopper, for example, and you're out there shopping CDs, like here's kind of the range. If you give your money to the government for 1 month, 3 month, 6 month, you're actually going to get more money than or the bank, I should say. You give your money to the bank, you're probably going to get more than if you give it to them for 3 years at this point. We call that an inverted yield curve. This is a sign of something's not right in the economy. It's something that's been in place for a long time now, longer than it's ever been this way. And we're starting to see the reinversion. When this changes and goes back to a normalized curve, which should be up and to the right. That's a normalized curve because it makes sense. If you give your money to the government for, say, 1 month, you should be getting paid less than if you give your money to the government for 10 years. That's not necessarily the case right now on the very short end. Well, the Feds control the short end. So when they start to drop these rates down, that's going to reinvert the curve. The curve is usually reinverted when there's a recession upon us. Something's going on. President Trump Secretary Bessent have been on the Fed. That's why all that drama and hoopla we saw earlier last month. And then we've seen the Trump administration attacking Governor Cook for mortgage fraud. They're trying to get at the Fed in any way they can to drop these rates. Why? Because it's driving the deficit out of whack, because the cost of money for the government is high. And also they know that if the rates stay too high too long, the economy will slow. When you raise rates, in lower rates, there tends to be a 9-month lag. Well, I'm not a mathematician, but if we get the rates down right now, and it takes 9 months for the stimulation of that to kick into the economy and for real, like really kick into it, well, that's looking pretty good for re-election time. So, or I shouldn't say re-election time for the president, but re-election time for the House and for the midterm elections. So that's kind of conspiratorial, but if I was a politician, I would be doing everything I could to push rates down so that I could solve for the election coming up. Because like good old President Clinton once said, it's the economy, stupid. And if you're not if the economy's not kicking trash when it's time for re-election, you're not going to do very well.
Daren, if I'm trying to read into these 1 year through 5 year rates, which are lower than the short term rates, would this be the bank basically saying like, yeah, we're not so sure what's going to happen from the Fed side when we start going further out. So we're going to drop that because it might be lower at that time. Is that kind of what they're saying? Uncertainty about the Fed?
I mean, I guess you could extrapolate that. I mean, it's saying a lot of things. What the Fed is saying is they're not sure that inflation's under control. And then thus they're keeping the short end of the rates high because the Fed only controls the short end of the rates and the market controls the long end of the rates. So the Fed's keeping rates elevated, and that's where Secretary Bessent and President Trump have been like, look, lower rates, lower rates, lower rates. The problem is everyone's like, oh, lower rates, and that'll make everything better. I can afford a house again. I can refinance my house. But along with that comes a whole other bag of tricks and things we have to combat with in the economy. And if they can very slowly and carefully let the pressure out of the balloon with the rates, if tariffs don't push inflation much higher, which there's a ton of debate about, then things work out okay and growth actually picks up. Inflation continues coming down. The issue is if inflation goes up, but all of a sudden we're seeing these jobs data come in that doesn't look good, that's telling you that growth is likely slowing down, and you've got inflation high and growth slowing. That, my friend, is called stagflation, and that is not good and very difficult to deal with. And so the Fed has been very hesitant to lower rates because they still see elements of inflation in the system, and thus they say, hey, we can't lower rates. If we lower rates, we might stimulate too much. That might push inflation up. Meanwhile, we have the politicians saying, we don't really care about inflation. What we care about is getting reelected and to live to die another day. So you have this political macroeconomic battle happening out in front of us on the stage, on the Wall Street Journal, on Financial Times, in your local news station. But that's the drama unfolding right now. And with the data coming in on the jobs, that gives the Fed more coverage now to say, maybe we can lower rates because you're starting to see that tick up. Now, we're only at 4.3 on the unemployment rate right now. What's interesting is when you look at the unemployment underneath the hood, it's far worse for younger workers. And some of the postulation is the reason for that is because AI is taking entry-level jobs now, and we're already starting to see the impacts of AI, which seem to be something that will be very significant. I suspect in these next midterms coming up, you're going to see a lot of the politicians talking about those type of problems because it is something that the politicians are going to have to contend with and figure out in order to make things keep working for us economically, which is also, and it's a wag the dog thing. I think it's also interesting that we're in these very interesting and precarious economic times with literally, we are living through the equivalent to the Industrial Revolution that we all read about in the history books. We're living through the technology revolution, the AI revolution, that in the next 10 years, we're going to go through like 100 years of technological development. I don't think it's coming right away. I do think we're going to hit the S curve first, which means everyone's all stoked about it, and then it goes into the basement, and then all of a sudden it changes all of our lives. I do think the S curve of adoption is headed our way. I do think we're going to have a bubble in AI. I do think these stocks that everyone's saying are always going to go to the moon and forevermore will eventually come back in. Case in point, NVidia, you saw in Microsoft, both down today. Market actually wasn't that negative across the board. It was just really technology in Microsoft, NVIDIA, and financial and insurance. All these companies down here really impacted by a quick drop in rates. What we saw in the 10-year earlier today was pretty strong move down. And you can see this is the 10-year rate moving down. We talked about this a couple of weeks ago where we think support's kind of coming in here around 4 and change somewhere in there. I could easily see a move over the next few days right down into this area, bounce up, and it continuing to consolidate along this area. We lose this line of support right here. Actually, that was really ugly drawing on that one. But if we lose the line of support right here, I think we'll have lower rates pretty quick. The problem, and we say this a lot, it doesn't matter so much what direction the market is headed. If rates go down really fast, that's problematic. If rates go up really fast, that's problematic. I.e., you saw that in 2022 when rates went up really fast. That was problematic for bonds. All the banks collapsed. That was problematic for the stock market. So if rates go down really fast, in theory, that could really be stimulative of the economy. The problem with that, if rates go down really fast, is because something else. The wheels have come off the bus. So let's dig a little deeper and see if we can find out what else the market's telling us. So if we look into oil and say, okay, what might oil be telling us? If you think of oil is in everything, look around the room you're in, listening to me talk right now, and 90% of the things you look at, you're sitting on, you're staring at, have oil-based products in them. They are all through our house. They are everything in the economy. And so we watch oil really closely because it is one of the base items that everything is manufactured off on some level. Even the machines that even manufacture things that aren't made out of oil had to use oil. So it's pretty important. And as much as people might hate the pollution oil gives, everybody drives a car. So, and you can see we're looking at this rate right here, this oil chart, and right around 60 is what I'm watching closely. Because if we lose 60, I think we got weakness. Here's what I don't like about this chart, which makes me think oil is going lower. One, we've obviously been in a downward trend. Two, we went down to this area once and twice, and support held. When charts visit the same spot over a short period of time consistently, what happens is the buyers that are buying at these support areas tend to get worn out, meaning there's not as many buyers there eventually. And then the sellers overwhelm the buyers, and that's when we go down. Based upon this chart, if the economy is about to slow, if unemployment is going up, people are spending less, they're pulling back, they're driving their cars less, there's less oil to go around, they're not traveling in planes as much, that all impacts oil. Additionally, if we see things start to calm down in Ukraine and Russia and the oil politics of the world, and we see the Middle East calm down, that means there's more oil coming online, coming into the system, more people are going to be consuming that oil, or there'd be more out there. And supply and demand laws basically say you got more supply, and if demand doesn't meet that supply, then price goes down. So watching the oil chart really closely here, I do think it is something to pay attention to. We're revisiting this area again. It's not been very long. We revisited it back early part of the year, and here we are again. That tells me there's probably weakness here, that the buyers probably getting worn out. So where would it go? I definitely can see how important this area was on the chart back in 2019. I could see a stop in this general vicinity with oil. Things get really bad, then you see it plummet, and you could see during COVID where it just fell out of bed and hit its head. Let's take a look at NVIDIA. NVIDIA is the stock that is priced for perfection, is a stock we've been talking a lot about for a long time because it's propped up so much the S&P 500. S&P 500 is the largest 500 US-based stocks. NVIDIA is the biggest stock. So if NVIDIA goes down, look at all the other stocks that have to stay green for the market to stay up. And NVIDIA's priced for perfection. And when you've got a stock priced for perfection, that can be problematic over the long term because life ain't perfect and nor is any stock. And then add Microsoft, the other big AI company, and you can see we certainly seem to have topped out. At that point, we stopped along support right where we're at 495. Looks like, though, based upon that close today, that's pretty weak. I think we're probably in for 480. Right on time, though. Dan, Chris, have we not been saying world's going to fall apart in September? I don't know what the excuse is going to be. All the traders come back. Here we go.
Well, it's interesting too. If you look at the 2-year rate, we also were at a similar bottom in the 2-year rate about this time last year in September. So that seasonal weakness happened around then. That's when the Fed cut, and that's where we're at today. I think we got below that low from a year ago, but interesting that also happened in September in the seasonal period.
Yeah. So seasonality, what does seasonality even mean? And it just means that there tends to be ebbs and flows to how the market goes. And as much as retailers like to think that they're the big dogs in the market, they're not. They're the small dogs. And those diamond hand Reddit readers, there's just not enough of them to overwhelm the world of institutional trading. And what we tend to see in the summer is things float higher. We come back into September, and magically the markets go down lower. Why? Well, who knows? But we can surmise that perhaps all the traders on the street don't really like the prices that floated up in August. That's conspiratorial. However, could be. So what do we expect? We expect it would not be shocking to see a rough September. It would not be shocking to see all kinds of ugly headlines coming out and jobs data this and jobs data that. It all is going to be the end of the world and the markets are going to fall apart. And then lo and behold, somewhere around mid-October, approaching November, the markets are going to pop and they're going to go back up. Why? Well, everyone gets bonused in the end of the year. So markets tend to recover and we want to have a good Christmas. Christmas comes in, January comes in, everyone overspends. Things tend to be pretty mixed going through that. Then you have the spring come on and then we get into summer. But September tends to be a season where the market doesn't do great. So expect that. Don't get emotional with your portfolio. Back off. Go read a book. Enjoy the fall weather here in California. Hopefully it's not too smoky. All right. So interesting, though, Chris, that's a good point where that 2-year went to and where it's sitting, which is rather precarious, signaling to me once again that I think it's more likely that rates go lower at this point than they go up. Look at the Agg for a clue. What does the Agg say? The Agg is the largest. This is like the aggregate of the bond market. So this is quote unquote the bond market. We talked about this, Chris, last week. I said, hey, you're excited, Chris, because we're coming right into the neckline of this important double top we had way back when. And look, lo and behold, it's coming up. And there we are. We broke above that neckline. We popped above it. We came in. We tested it. I think it's blue sky for the Agg, which is really great for our diversified investors. We can only hope the stocks don't completely tank, but we've had lots of investors who are less risky than some of the Reddit crew and like their stocks. And let's take a look at EDV, which got absolutely crushed and pummeled and beat up all through 2022 and has not done a thing. EDV is the long extended duration treasury. So it's buying treasury bonds that go way out on that curve. And we had a nice little jump today. Look at that jump, Chris. That must have made your heart pound.
Well, like you said, though, it hasn't gotten out of no man's land yet. Although the good thing with those long-term treasuries is with rates, they were knocking on the door of 5%, not that long ago. So you are finally getting paid something to hold them. There's a carry to bonds, unlike most of the 2010s period when rates were practically nothing, culminating in 2020. There was hardly any income from bonds, and that's changed with this sell-off that we had in 2022.
So, Chris, you can get super excited when we break above this line right here. I think we break above that. I think we're going to see some higher sky with the extended duration. Here's the bad news. If Chris gets excited about the extended duration treasury bond, that means that rates are going way down. We're in trouble. So
yeah, you're
everyone
back to the
pray
good
that
news,
Chris
bad
doesn't get
news.
excited.
Careful what you wish for.
Good news, bad news. Yeah.
Exactly. So in LTPZ, this is the 15-year PIMCO ETF. Again, another example of the long duration type bond holdings. And that's a pretty good little bounce in one day.
That's the inflation protected version of long-term treasuries. And again, you see the drop off when the rates went up dramatically. It just crushed bonds across the board, even those that were inflation protected. So a lot of people say, well, gosh, these are inflation protected. We got high inflation. Why did they do so poorly? Well, it's because of the interest rate portion of that that got hit. But where are we now? We've been trading sideways for years. There's actually a decent there's a decent yield, that it's paying while you wait. And if we get that lower interest rate environment, and even if we don't, like if it holds steady where it's at today, real rates are above 2%, which is a decent historical place for them to be.
It's a decent place if you like used cars and Mercedes-Benz. All right, let's talk about gold. All right. I mean, Chris, if you want to get excited about 2%, you do that. You go, boy.
Well, it's 2% real, so that's over inflation.
That's right.
All right. So gold, let's talk about gold. Gold broke out. So it would look like it was distributing. And I think we talked about this a couple of weeks ago. I'm like, I don't know. That looks like it's distributing out. And I was watching this support line right here and whoop, we moved right up. Gold breaking out with I guess we can call this a bull flag now. So I would expect a pretty decent sized move in gold if it holds here. Upwards, which again is not good for risk assets, because if gold's going up, well, guess what? Oil is probably going down and treasuries are going lower, interest rates going lower, and stocks are probably going to follow. We'll see if bonds are the true diversifier that they say they are, and they haven't been, depending on what happens here. Again, it's all about the rate at which it moves, whichever way it moves. Interesting day, okay? SPX, which is the S&P 500, red. RSP, which is the equally weighted index, actually not as bad. So it is possible that we're starting to see a rotation. What do I mean by rotation? All of the money has been going to Microsoft, NVidia, Apple, Amazon, Tesla, Google, Meta. Money's been flowing into those stocks. It's possible we're seeing a rotation now where the beginnings of where money is going to rotate out of those stocks and go into the other stocks. Oh, Dan, look at Disney. What a bad day for Disney. Shocker. I'm waiting for the jest back. Come on, Dan. You got it.
I can't. You know what? I guess I'm all good, dude. I'm all good. I'm very happy.
Okay. For the audience, Dan loves Disney, and we go back and forth all day long about
I have certain pieces that I really like about it. Yes, I do. Yeah.
Okay. We'll let you have certain pieces, Dan. So we could be seeing a rotation happening, right? So that's interesting, but the RSP doesn't look nearly as bad, which is equally weighted, which is those boxes all being equal sized. Now people say, well, but Daren, the stock market's still going up. Yeah, it is still going up, but look what happens. As it goes up and it kind of slows down, then you get these events where it falls out of bed. And perhaps we're seeing that. So what am I targeting as support? Let's say the market sells off. The world's going to end in September and all the media scares everybody. Here's what I'm looking for. I'm thinking somewhere around there is support. That's what I'm watching for support, is somewhere in this range. if things sell off. There's obviously a lot of support right in here first, but I could see something like that with the correction and then a move forward. So I wouldn't be freaking out, but that makes sense that we would trade down into that zone for the next month, month and a half, have a nice little correction, which just happens to coincide with this all-time high here. Would make a ton of sense to see a lot of buyers sitting right here and right here. And if the market trades in, say, we'll take the price, let's move. That makes a lot of sense to me. So good time just to be patient, to not worry about what the media is pumping through your brain, and to stay the course with your investment lineup. Let's look at the front end of the tip when it comes to the tip of the spear for risk. This is the Bitcoin chart. You can see we had a double top and we had a neckline. What's interesting is we broke below the neckline. We came up into it and sort of looks like a rejection of the neckline, which isn't great. Let's look at a 1 hour chart on the Bitcoin chart and just take a little bit closer look on this. And you can see there's that neckline right here. This is the neckline of that double top. The double top again is here and here, the neckline right here. And we traded below. We couldn't hold it. We went back below. We tested it, couldn't hold it, went back up, couldn't hold it. That's showing me there's weakness here. That means there's a lot of sellers sitting right in here. So anytime Bitcoin goes up to there, they sell it. Based upon that chart, wouldn't shock me to see movement downwards. Front end of the tip of the spear kind of signaled this one, guys. What can I say?
So you're saying that because of the action in Bitcoin frequently, we've said this before, but if you're new to the show, Bitcoin's a leading indicator, meaning it's happening in Bitcoin potentially before it's happening in the S&P. You're seeing downward trend in Bitcoin right now, or at least some sideways action. Therefore, you're thinking similar in the S&P?
Yeah, I mean, I just think that like you're starting to see, you saw the weakness in Bitcoin first, and now you're starting to see some of that weakness in the S&P. I'm not going to write home like this was a super weak chart. I don't think that's the case. We got a pretty good drop out of that jobs data today. And that brought the chart right back under this resistance, which is buyers said, I'll sell there, I'll sell there. But it didn't plummet the thing all the way down or anything into this support level. So I'm not overly concerned about the S&P at this point. I do think we're going to see a more difficult market through September. The other option is you kind of get this, I don't know, sideways choppy thing here, and then it comes into that support line, but over a longer period of time. But you know, I'm kind of personally, and this is just complete speculation, I have no idea what's going to happen on this side of the chart, right? Like that's the $10,000 question. But I could see the market trading into here, and then you know, there be support here, and then some type of news event will send us up into the end of the year. Everyone says that markets aren't political, but they are. So I don't, it's like the Fed isn't political, but they are.
It's not even political though. It's just gossipy. It's like junior high. It's like, oh, what are you talking about? Oh, yeah, that's a thing now. Are you into that thing? Oh, yeah, definitely. I'm very into that thing. Oh, yeah, it's going to be huge. It's going to be massive. Oh, yeah. Oh, we're off that now. Yeah, we're off that. You know, it's not actual politics.
Yeah. Yeah, it's interesting. Let's look at developed and emerging, right? So just kind of a similar chart. Being diversified globally in stocks isn't doing you much good at the moment. It did help you a lot earlier in the year. But at the moment, not, although they had a nice day today, not doing a ton of diversification value right now. I think Chris wants to comment on that.
I'm just sitting here waiting for you to throw it to me. All right. Well, okay. If you look at the longer term on the developed chart, you'll notice that we're finally hitting all-time highs after, I don't even know how long, many, many years. And so again, if you're looking for a place that's kind of been left for dead and there possibly is some upside, you know, it's just now hitting all-time highs. It's not like the S&P that's been hitting new all-time highs for, you know, years and years and years, right? And same thing with the emerging markets. We're not even back to the high that it saw in 21, despite the strength that we've seen so far this year in emerging markets as well. So, roughly they're outpacing the S&P 2X right now. And so we'll see if that continues.
Yeah, like right now, you can see 25. This is where it was. What is it up? Since the beginning of the year, we were down here. 24% up in developed world. Yeah, I don't think anyone called that one very well.
Yeah, you're probably loving it if you picked this up 5 years ago when no one was calling you about it, Chris.
To Chris,
people still don't people are still shocked when you tell them that this is happening. They're like, "What? Really?" So it's still under the radar for sure.
Here, Chris, we'll give you an applause.
Thanks, guys. Thank you.
Yeah. Chris, to Chris's credit, like I've heard him over and over in appointments with clients being like, yeah, you need some emerging. Yeah, you need some developed. Everyone's like, global stocks are garbage. And he's like, no, you need some. And people just weren't having it. And, but he was right, man. It really proved the diversification. When I was saying it didn't do really much, it's just right in the moment, right? It's kind of locked up right here, just like the S&P is. All right. I think that covers it all. Did enough damage for the day. Any last thoughts, guys?
Chris?
No, I think it covers it.
Let's just wrap up our initial question, which was be careful wishing for rate cuts. So the idea with this episode was that, hey, rate cuts seem like a really great thing, especially if you have been waiting to refinance or if you've been looking for funding for your small business or something like that. But that also could indicate that we have a significant economic downturn happening, which is why they're doing the rate cuts. So we showed that over several slides. And Chris, just out the door, your opinion, rate cut, yes or no, should it happen?
Yes, but not as dramatically as what's being called for.
Daren?
Are you asking me, do I think a rate cut should happen?
Mm-hmm.
I think a little bit of rate. I think they should start letting some of the rates go down. I don't think I would aggressively move them down because I do think inflation's still a risk.
We are Sonoma Wealth Advisors, the Fermata family of brands, including Sonoma Wealth, Fermata 401k, Fermata Tax. If you're one of our clients, we thank you so much for checking out this show. This is a fun thing for us three to get together and do at the end of the week, wrap up the market and see some of the happenings and share that back with you, give our take on it. And if you're new to us, if you're new to our firm, if you're new to this show, a couple things you can do to engage more and learn more about us. You can check out our website, sonomawealth.com. Check out our free wealth analysis. And wherever you're listening or watching right now, you can subscribe to this show and check out not only this show, but a couple of our other podcasts as well. So make sure to subscribe, make sure to like if you have the ability to do that. And we will see you next week on the markets. Thanks so much for checking out the show.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. Fermata Insurance. Appropriate insurance is an important part of a financial plan. Find out what coverages you may be missing at fermatainsurance.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.